Well, we're 2 years into this dip, and the Nasdaq is nowhere near where it was 2 years ago. So that's the first thing. That's going to get worse because the U.S. is heading into a recession, and we may be in a recession.
Jim Rickards, a prominent financial analyst, presents compelling data pointing towards a concerning outlook for the U.S. economy in 2024. The Nasdaq, having peaked in November 2021, has been on a steady decline for almost 2 years, particularly signaling trouble in the tech sector. Despite a seemingly positive 5% GDP growth in the third quarter of 2023, Rickards highlights the reliance on consumption and inventory buildup, warning that a consumer slowdown could lead to inventory write-downs and subsequent price reductions. Drawing parallels to historical events, such as the 1970s stock market downturn, Rickards urges caution, emphasizing the potential for a looming recession in 2024.
I think I can keep this brief in the sense that a lot of what's going to affect the stock market is the geopolitical situation. So we talked about that in depth. But if you got a 401k and you're just buying the S&P 500 index from Vanguard or Fidelity, and it's been going up, and it has been going up, there's no question about that, and you're like, I'll just sit there and watch it go up, be careful. We've been warning about a stock market decline for a long time. It's happening. I mean, by the way, the Nasdaq, people forget this because Wall Street's out to sell you stocks, and CNBC says up, up, up. The Nasdaq peaked in November 2021. Go look at a 3-year chart and say, well, gee, what was the all-time high of Nasdaq? It was November 2021, and it's been down ever since. Now it went down and came back, and it's going down again. Okay, there's volatility, and if you're a day trader, fine, good for you. Good luck trying to pick the spots. But the fact is, it's been going down for almost 2 years, and it's going down pretty heavily now because the air is out of the tech balloon. There's nothing I see that's going to make that better. I don't think the Fed's done raising interest rates. We'll talk more next week about what could happen. Yeah, and I remember the 1970s. The stock market peaked. Dow Jones peaked in 1969. It didn't get back to that peak until 1982. Now, okay, 1982 was the beginning of one of the greatest bull markets in history, grant that, but 69 to 82 is 13 years. It went sideways. Now, again, there's volatility and dips and peaks, and I'm not saying you can't make money, but I'm saying that there's a 13-year period when the stock market ended up where it started, number one, around 1,000 on the Dow. And when you adjust for inflation, because we had massive inflation like in the late 1970s, it was still down. So that's 13 years. Well, we're 2 years into this dip, and the Nasdaq is nowhere near where it was 2 years ago. So that's the first thing. That's going to get worse because the U.S. is heading into a recession, and we may be in a recession. Everyone's like, wait a second. Yesterday, GDP was up 5%, and it was. That was the number for it was the first government estimate for the third quarter of 2023. It was up 5%, but it was very heavy on consumption and very heavy on inventory. So when those two things, well, consumption, obviously, but people don't realize when wholesalers and distributors build up inventory, that counts as GDP. Well, it's fine to build up inventory if people are buying the stuff, but if they don't buy the stuff and you're up to the rafters in inventory, you got to start writing it down. This is where you see, you go to the Gap and you get like 10 shirts and 5 pairs of jeans for $30. I mean, this is what happens. They slash prices. They do 2-for-1 sales. They just move the merchandise, and particularly in certain areas, stuff goes out of style. In the fashion industry is notorious. Who wants last year's, coat or whatever. So then the inventory situation comes down to the consumer. Are people buying stuff? It looks like the consumer hit the brakes in August. Now, the second quarter is July, August, September. Sometime around mid to late August, after 2 pretty strong months, and they were strong, the consumers just hit the brakes. Now, they'd done enough to make the third quarter strong, but going into the fourth quarter, they may just not show up for the game. A couple of reasons for that. Number one is during the pandemic, you go back to 2020, 2021, what was going on? Well, starting with Trump in, I think, June 2020, he gave everybody a $1,400 check. If you got a heartbeat, you got a check. And then Trump did it again in December 2020, sorry, just before he left office. It was another $600 check. Biden comes in and says, well, I can top that. And Biden does in February 2021, right after he was sworn in. Here comes another $1,600 check. And then there was Build Back Better, the Inflation Reduction Act, which is actually the greenest scam. I mean, we were spending we were running deficits of $2 trillion a year for about 4 or 5 years. The total spending was higher than that, but that was the deficit alone was about $2 trillion a year. Nancy Pelosi handing out money. Well, the Americans got used to that. Thanks for the check. And then there was a deferment on student loans. You didn't have to pay your student loans for about at least 2 years, maybe a little bit longer. And then when people got those checks, they saved a lot of it. So what happened in 2023? People drew down their savings. The savings rate got really low, like 3%. It was up around 13% during the pandemic. It's about a little over 3%, 3.5% right now, which is low. They spent the savings they had. They didn't make new savings. And then they turned to the credit cards and ran up their credit card balances. Well, that feels good for a while. But then if you're paying the minimum and rolling over the balance and you're at your limit, your credit limit's used up, and the interest rates are 20%, some of them are 28%, you're going to double that balance in 3 years. So if you're like, I'll just pay the minimum this month and I'll figure it out, your balance is going up because the interest is compounding faster than you're paying it down at 25, 20 to 25%.
In this next discussion, Jim Rickards warns of imminent challenges for the US economy, backed by data indicating consumer strain on credit cards and depleted savings, evident in reduced gasoline consumption. Despite lower gasoline prices, a potential disinflationary trend raises recession concerns. Recognizing a consumer slowdown in late August, Rickards recommends reducing stock exposure, increasing cash reserves, and turning to safer alternatives like Treasury notes. Strategic investment shifts toward defense, mining, and energy sectors are advised, with a cautious approach to tech. Staying attuned to geopolitics is crucial, as global events could exacerbate the fragile stock market. In uncertain times, Rickards emphasizes the need for strategic moves and a nuanced understanding of economic dynamics for savvy investors.
So people are tapped out on their credit cards. They've used up their savings. They're getting into a deeper hole because the interest is compounding faster than they can pay off the credit cards. And they're just backing away. And it's showing up in things like gasoline consumption. It's way down. Gasoline is what economists call, the demand for gasoline is what economists call inelastic, meaning you just have to buy it no matter what the price is. You got to take the kids to school or get to work or go shop, whatever it is. You're just going to buy the gasoline, even if you don't like the price. By the way, lately prices have been coming down a little bit, which is that sounds good, but it's actually a bad sign because it's disinflationary, which kind of leans in the direction of a recession. But for gasoline consumption to drop, forgetting about the price, that means people are not driving. They're not going on vacation. They're not doing road trips. They're not driving any more than they have to. There are a lot of other signs. We don't have time to get into all the technicals with negative swap spreads and inverted yield curves and all the rest. But it does look like the consumer slammed on the brakes around late August, early September. The fourth quarter could be a disaster. The stock market's starting to wake up to that fact. So I would say it's a pretty simple recommendation, Matt. Reduce your exposure to stocks overall. Increase your exposure to cash. It'll give you, you won't lose money on cash, assuming that inflation is not bad, and it'll give you a lot of optionality. You can go, if things get really, really, really bad, if you have cash, you can go shopping and find some bargains. But if you're in stocks and they go bad, you're just going to lose that money and never see it again. But if you do have stocks or some stocks, I wouldn't do the index funds. I would look at energy, defense, not for good reasons. There's enough wars going on, but defense will do well, and mining because gold and silver prices and strategic minerals will do well. So defense, mining, and energy are the sectors I'd be in. I'd lighten up on tech, get out of everything else, go to cash. Treasury notes look attractive here because interest rates are going to start to come down. I know they've been going up. I get it, but it looks like they peaked and have turned around. So treasury notes, a good 2-year note, a 5-year note will perform very well, and they're very safe, obviously. And just take it from there. But you've got to be tuned into the geopolitics to understand the stock market. You can treat them as separate subjects, but if the world's falling apart, so that's not good for stocks.
Today's insights from Jim Rickards paint a sobering picture of the US economy, with key indicators pointing towards potential challenges ahead. From the Nasdaq's prolonged decline to consumer spending patterns, the warning signs are clear. As you navigate these uncertain times, remember to prioritize your financial well-being. If you found this information valuable, don't forget to hit the like button, subscribe for more updates, and share your thoughts in the comments below.